All right, welcome back. Do you want to do the little? Here we go. Welcome back to Total Money Management, and this is question time with Steve. All right, turn that off now. It's in my ears. We found a new button on the Rodecaster. Thanks, Dan. We're back with Tom and Steve. We thought we'd make a bit of a mini special. We had a masterclass last week, or whenever this gets released, might be a couple of weeks ago. We had a bunch of questions that came through our platform, just through the website, and everyone that kind of subscribed to the free session. And we thought, rather than sticking it all into a masterclass and going over time, we'll do a mini special and cover all the questions.
Righto, fire them off.
So the first one was percentage of exposure to share markets within superannuation.
Okay.
Not financial advice.
Not financial advice, right. One of the reasons why you can use self-managed super funds is because we have a document called Why You Should Manage Your Own Money: Cost, Choice and Control, right? Yep. 3 C's. Okay, cost. It's generally cheaper to do it yourself, like it is for most things, right? Choice, you get to choose, and these are the important ones. You get to choose where you want to invest your money, right? So you might say, man, Brazil's cheap. And the super fund says, sorry, dude, we don't do Brazil, yep. Right? Which they probably don't. Okay. And the last one is control. Okay, that's a really important one too, because you're able to say, okay, Cape's at 39, things are really crazy. I'm going to sell down my portfolio and go to cash, right? You can do that. Generally, what happens these days is because of self-managed super funds, what a lot of mainstream, industry funds and Q Super and all those sorts, they will now allow you to do a certain amount of stuff, right? So you might say, I want to do I think there's a self-invest one. I think it might be Q Super, where you can go in and say, okay, I'm going to buy VAS, right? Australian shares, I'm going to buy Korean shares. And so you can sort of manage your own portfolio. Okay, and there's nothing wrong with that because they do all the admin work, which is really laborious, let me tell you. So at that point, you can look at self-managed super funds, or you can stay with your fund, but get on there and be more active about it. The big point really is moving your asset allocation, right?
Well, that was the question, right? What percentage of my super, what percentage of super would you allocate to stock markets?
Okay.
And it sounds like the short answer is it depends on valuation and what markets.
Bingo.
It's an asset allocation thing, right?
You might say to me, Steve, how much should I invest in the US? And at the moment I'd say, okay, Tom, nothing, because it's crazy. You then say, okay, well, that's great, Steve. Now what do I do? And I might say, okay, well, Tom, you should invest in gold because it's not correlated with stocks, right? So that's where, again, it's useful. The point is always, people always think if we say, oh, you shouldn't invest in stocks in the US, then it's like, oh, well, there's nothing to invest in. It's not about that. It's about your asset allocation, right? It's about saying, well, things are expensive. Okay, well, just bet 10%. Things are really cheap. Okay, we'll go 80%. And what we know about markets is, you've got uncorrelated assets, which we talk about in diversification, but saying, look, when stocks do well, gold generally doesn't do well. When gold does poorly, generally stocks are doing well, right? And bonds. And so generally, as I say, it's really down to valuation and the asset classes.
Okay, cool. Next one is, how does Cape get valued? Nice and easy.
Look, it's a 10-year indicator. Let me give you an example. It's 2011, January the 1st. The way they do it is say, okay, from 2000 to 2010, every year here are the earnings, add up all the earnings and divide it by 10. So think of 10 men walk into a room, you measure their height and you go, okay, the average height's, 6 foot, yep. Right? And you say, okay, at the moment, everyone thinks the average height's 6'5". It's like, okay, you need to be careful.
Yeah, because the next few may not be 5'7".
That's exactly right. So that's how it gets valued, so to speak. It's not, Cape is not valued. What Cape is an indicator to tell you about value, right?
Or future value.
Yes, yeah. So as we often say, if the CAPE is 20 and the all you do is you say, okay, 100 divided by 20, okay, I'll probably get 5%.
Yeah.
Right? If the CAPE is 10, you say, oh, well, that's good. I'll probably get 10%. So low CAPE, high returns.
Yep.
High CAPE, low returns.
Got it. Thoughts on global ETFs, hedged versus unhedged?
Yeah, tough one, really. Global, at the moment, global markets are really expensive, but let me put a caveat on that. That's because the US is like really, really crazy. Emerging markets aren't too bad. So again, it gets down to, stocks are expensive. No. The US is expensive, but Brazil's cheap or Mexico, right? So you got to go down to that second level.
And there's a bit of a currency risk as well.
Yes, hedged and unhedged. Generally, what I say to people is currency washes out over the long run, right? So you can buy stocks when the Australian dollar is a dollar, right? Parity with the US. That's really great when you're buying stocks. Now, if you want a dividend, you want the Australian dollar to crash to 50 cents. Right, because then the reason is the US says we'll pay you $1. Well, in Aussie dollars, that's $2.
Yeah.
Right. So ideally, what you want to do is say, I'll buy when the Australian dollar's strong, and then I'll get the dividends when the Australian dollar's weak. Yep. So hedged and unhedged. Look, it's a tough one, really. You can hedge, but again, you might hedge at $1 and then go, oh man, I could have made 40% on if I wasn't hedged. So it's a little bit of a lottery.
Yep. Okay, fair enough. How long do you think the markets will stay at these ridiculous valuations?
How long's a piece of string, right?
7.
Look, 7, right? 7. Look, the real answer is no one has an idea, but that's not really the point. The point is saying, what are you earning now? Right? Not what have you done. If you've done really well, excellent. But now you need to protect that capital, because if you wake up in 12 months ago, man, the stock market went down 50%, then you'll have wished you'd sold a lot earlier.
Or thought more about your asset allocation.
Yeah.
Okay, from an earlier question.
Absolutely.
Dave Reynolds was asking, why doesn't Steve like Bitcoin?
Right, because he's an old fogey.
Next.
But it's not... Look, I don't like Bitcoin, but the reason why is because I can't value it.
Yep.
Right? I'm not a big fan of gold, right? But I've got gold in my portfolio, and I can tell you I made 150% in 12 months. Now, but the point being, if you said to me, hey, what's gold worth? It's like, I don't know. Because the same with Bitcoin. I don't know what it's worth, but it doesn't mean I can't make money out of it.
Yep.
Right? All I'm doing is saying, for God's sake, just avoid catastrophe, right? And that can happen with Bitcoin as it can happen with gold, right?
I think he's coming around to it, Tom.
Well, no.
Digital gold, yeah.
It's just that with a stock, you can look at a stream of earnings like CAPE, right, and go, oh, okay, the market's worth X. With Bitcoin, you can't do that because it doesn't earn anything, right? It doesn't pay you a dividend. Right. So do I like it? No. Do I think you shouldn't have it in your portfolio? No, you should. If you look at it and go, okay, I think it's going to work. It's like, okay.
If you have a system. Yeah.
Well, just beware of the risks.
Yep. This is similar to the CAPE one. If you have moved to cash, when would you start buying shares again?
You look at the valuation.
When it's cheap.
Right. See, yeah. And see, when CAPE's at 39, you might be waiting 2 years. Right. And I think we said this about COVID. When COVID struck, the US was at about 33 and it fell to 23. Now that's a 30% drop, but it still wasn't cheap at 23. Right. So now it's at 39. So what happens is people will see a 30% drop and go, man, the stock market's cheap. And it's like, dude, it's still at, 27. It's got a long way to go, right? And so, again, don't watch that daily squiggly line. Look at the earnings yield, because if the earnings yield is currently, Well, the dividend yield in the S&P is currently like 1.1. I mean, it's goddamn miserable, right? Now, if I come back to you and I say, hey, great news, Tom, it's now 2.2, you go, okay, that's nothing, right? But that means the dividend, like the market's fallen a lot, but you're still only getting 2.2, right? So my point being, you've got to look at the earnings yield to say, I'm going to get in now. Why? Because I'm getting 8, right? Not because I'm getting in now. Why? God, the market's fallen a lot. It's like, okay, but it could fall another 30 or 40%.
Yeah.
Right?
Number 7, what commodity ETFs do you think are attractive? Bit of a dangerous one.
yeah, that's a bit of an open-ended one. What's that? What do I think is attractive?
Which commodity ETFs?
Oh, okay. Yeah, tricky one. I think the best thing you can do with commodities as a group is a little bit like saying, it's like the equivalent of the Australian ASX 300, right? So you can say, okay, buy VAS. I think with commodities, you're better off saying, okay, I'm going to buy an oil ETF, I'm going to buy a natural gas ETF, I'm going to buy a copper ETF, and I'm going to buy a rare earths ETF, right? So it's better to become a little bit more segmented. I think that's the best approach with commodities because, again, commodities are just this commodity. The word commodities is just for a whole raft of things. Iron ore's a commodity, wheat's a commodity, corn's a commodity, oil's a commodity. So you're better off actually saying, like we do with the US, is say, okay, information technology is really expensive, but energy is really cheap, right? So it's a little bit like saying iron ore is really expensive, but rare earths are cheap. Okay, well, I'll buy rare earths.
Yep.
So just take it down a step.
Okay. As valuations are at all-time highs, what has history taught us the best way to manage the risk, specifically the 70s, which led to stagflation?
Yeah. Look, it's just valuation stuff, right? The thing you've got to have as an investor is patience to understand when the market's overvalued, you can't bully it, right? The market says to you, Tom, I'm offering you 2. Your job is to say, thanks, come back when it's 10. Now, lots of people will go, oh, well, that's impossible, but it's not, right? The reason why is because when the market's gone up for 16 years in a row and it's going gangbusters, the last thing you're thinking is, man, I'm going to pick this up for a 10% yield, right? Because you're thinking, it just keeps going up. So generally, again, valuation is your guide and be patient, right? You just got, it's painful, but you just got to wait. Plus, there are cheap markets like we talked about before, right? You might say, well, Steve, Brazil's on a Cape of 9. It's like, okay, well, go and put some money in Brazil.
Okay, cool. How should a first-time investor think about investing a lump sum versus a build-up over time?
Okay.
Buy and hold versus...
Yeah. We answered that, I think, last week with lump sum versus dollar cost averaging.
Yeah.
So short answer, go and have a look at the blog or there's a week that was one that we can send you. Write to us, we'll send it back to you. That's the answer. But again, it depends on what the earnings yield is when you start.
Yeah, it's all about when you start.
Yeah. You can't have an earnings yield of 1% and go, I'm expecting 11. It's like, well, I'm sorry, that's not the way that it works, right?
Well, that's the thing. Valuation and asset allocation takes care of half these questions.
Tom, absolutely, 100%, 100%.
The next question is the same thing: rebalancing and asset allocation.
Yeah. Come and do our course. No, but all seriousness, look, you have to remember, as you're making more money, markets cycle, and you have to take money off the table. Right? It's really hard for people to get used to. And again, it's like, if you're drunk at the bar, it's really hard to say, dude, you need to lay off and sober up, right? Because you're having fun, it's all great. But what we know is you're going to wake up tomorrow going, oh, man, I should have stopped at drink 5, right? And it's like, yeah, but I told you. It's like, oh, yeah, but I was pissed and, blah, blah, blah. That's what you've got to do in investing by saying, I've had a really good run. Cool. take some money off the table and wait because you'll get another really good run. Don't worry. I think it was Howard Marks who said, don't overreach for the last 5%. And that's what people do, right? They think they're going to get out at the peak, and you don't.
You never do.
Yeah.
Cool. Well, let's wrap it up there. And we actually really love these questions, so keep sending them in. We get a flurry through Instagram particularly, but send us emails if you need to. Other than that, see you boys next time.
Cheers, folks.
Cheers.